It is prediction time for 2025, the time where heroes and villains are made, where you look like a genius or a complete idiot. My brother schooled me last year. I will be giving him homage throughout the podcast. I'll try to one up him. Although I have some crazy stuff that I will share through the podcast. But before we get to those predictions, we're going to run through a tale of two markets, a very interesting technical situation in the market as we close out 2024. But before we do all of that, my brother has been hard at work creating what we call the Tackle 25 list. Now, that is a list of the best fundamental cash flow companies to do covered calls on. He is holding a webinar, and Matt, I have taken a look at this list. It is outstanding. Might be your best work yet, and you've been doing this many, many, many years now. Tell us a little bit about the list of the upcoming webinar.
Yeah, this is the 10th year of the Tackle 25, our primary core covered call list that we anchor against at Tackle Trading. It's the best covered call list in the world. There's hands down. I'll kind of like Elon. I'll go to war over that one. But at the end of the day, doing a webinar on December 30th. That is on Monday this coming week at 8:30 p.m. Eastern Standard Time. It's a registered only webinar, so make sure to go to tackletrain.com/live-events. The link is in the description below if you want to register for it. But at the end of the day, you know, Mark, the message of cash flow is vitally important. We are going to go through some predictions of 2025. And before I even get into those predictions, I think the disclaimer needs to be said. It's 365 days from now. There's a billion variables between now and
the first hedge of the podcast.
Thank you. I wanted to get the hedge out there. I wanted to get the hedge out there at the beginning. But the beautiful thing about covered calls and other cash flow systems that are with the Tackle 25 is it doesn't matter if you're right on your prediction. I wrote in the newsletter this week, having a little bit of fun, speaking as a Delta dog. For the directionally challenged individuals out there, the Tackle 25 is perfect for you. It's not reliant on the direction of the market. It's reliant on time and allowing time to pass. And all it takes is putting your butt in that seat and learning how to do it. And that's what we're going to do on Monday. And then in a week from Tuesday, we're going to do a webinar for only the pro members where we go through all of the lists together in the first coaches show of the year. And so that's going to be very exciting as well. So we're doing the webinar first on December 30th. That is on Monday at 8:30 p.m. Eastern Standard Time. Definitely register. You do not want to miss out on this webinar and covered calls in general. And then for the pro members out there, we will be doing the first coaches show of the year will be regarding the Tackle 25 as well. And so we got a lot to talk about over the next 10 days or so at Tackle Trading regarding cash flow, covered calls, and really making 2025 the year of cash flow. And so if that's you, if you're looking to make cash flow, the 2025, the year of cash flow for you, cash flow to get out of the rat race, cash flow to get out of debt, cash flow to offset inflation, cash flow to compound gains to leave a legacy, doesn't matter what the intention is, come over to Tackle Trading and start here with the Tackle 25 and make covered calls and cash flow and compounding part of your equation in 2025.
All right, listen, tell of two markets. I'm excited to get into the predictions, but we got to talk about, this interesting technical situation. It's one of those situations from a technical perspective that I really am shrugging my shoulders at right now. Like, I can see things from a bearish point of view. I see things from a bullish point of view, on multiple levels, and this is just the technicals. Forget macro, forget big picture on all that. And when I read the newsletter, well, there's a reason I had that shrug my shoulder moment heading into the week. It seems like we're seeing it kind of the same way. Break down what you were talking about in the newsletter.
Yeah, it's a concept we talk about at Tackle a lot regarding the consistency of multiple time frame analysis. And when one time frame is giving you a different trend and a different pattern than other time frames, it gets choppy, it gets difficult, it gets volatile, and pretty much everything we're describing in the market over the course of the last couple weeks. Now, specifically this week in the market, I don't feel the market was ill-behaved this week.
Nope, I don't either.
And I'm not saying that just simply because we got a nice little upward movement in price coming from overextended conditions. It was the development of the bearish retracement that was anticipated. And we got that bearish retracement. And the S&P 500 is not doing the justice that it needs to do regarding exactly what the bearish retracement that we're talking about in the overall marketplace. You look at IWM coming from an ultimate low point, for example. You look at the diamonds representing the ultimate cyclical areas of the market in a short-term bearish downtrend, coming from the overextended low point, getting up into that 9 EMA. That was base case. That's what we talked about last week in the newsletter, understanding the development of the ultimate bearish retracement. And then, Mark, when you start getting into what next, you can't discount the time it takes to fix the problems in the market right now. The market cannot get fixed in 1 day price action. That's impossible to do. We need to see development of patterns. And so the ultimate bearish retracement in the short term was that first pattern you really have to look at. Now, the tale of two cities, the kind of the theme I went in on the newsletter this week was based on the conversation we're having on the daily chart in the ultimate short term, navigating the bearish retracement, understanding what patterns have to develop following the bearish retracement to really get the buyers to, get back a little bit of confidence, Mark. The tale of two cities happens because in the short term, against almost every market index, you are seeing a short-term bearish retracement form. But in the longer time frames, the intermediate, the long-term charts, all you're seeing is a bullish pullback, a bullish retracement. So you have a short-term downtrend in the broad market with the bearish retracement, but you have an intermediate and primary uptrend on the S&P 500 with a short-term bullish retracement on the weekly chart. This is a mixed backdrop that has to be corrected before anybody, including Wall Street, algorithms, retail, consumers, I don't care who it is, this has to be worked out. And what I talked about in the newsletter this week was specifically what we need to see to work it out. But at the end of the day, Mark, this is not an abnormal conversation in the market. We see pullbacks in the market, and oftentimes these pullbacks in the market, as represented in the diamonds, as represented in IWM, as represented in RSP, every other index not named the Qs, which is holding up the spiders right now, they represent opportunity. And everybody knows that. Everybody and their dog knows that. Everybody knows the Warren Buffett quotes of, when there's blood in the streets, we want to be a buyer. Or, well, there's blood in the streets in the cyclical areas of the market. There's blood in the streets in the defensive areas of the market. Where's the buyers? Where's all these Warren Buffett acolytes going out and just buy? They're not going to do it without proper development, Mark, because the ultimate question is, have we seen all the damage in the market, or are we going to get another leg down? And so right now,
and that is a totally open question as we head into the coming weeks.
I'm not going to sit here and act like I have the answer to that question. If I did, I wouldn't have wrote a 1,000-word update in the Tackle Trading newsletter regarding specifically what you needed to see to get the answer to that question. And so, no, nobody can answer that. But what we do know is this. We know the patterns we need to see at the low point on a chart to really work out that volatility. We know what we need to see on confirmation on the S&P 500. And so it's yes, the way I described it in a tale of two markets in the newsletter this weekend was, a mixed market with some concern and some open questions regarding the viability of the upward movement in price. If you read that newsletter as the first time you ever read the newsletter, you probably saw it from a bear lean. You probably did, but that's not what I was talking about.
I read it when I read the newsletter, and I never ask my brother what he's writing about, because I always want to read it from just a consumer perspective, right?
No coach does. Mine really is the only writing we don't have that detailed conversation. But
and so and I read it, and I was like, this is an analyst who is writing about a technical backdrop that is unsettled, right? And in a bullish mega trend like we had in 2024, that can come across as bearish, but it wasn't. It was like, listen,
and I knew it might come across as bearish because we are looking at bearish retracements in the market right now. You can't discount that. You can't just say, oh, it's not a bearish retracement that's coming into the 9 EMA on IWM or the diamonds or RSP or the 20 period moving average on the SPY. My point is you have to navigate, speaking as a bull, you have to navigate that bearish retracement, because the bearish retracement is the first pattern that develops within an overall reversal formation. And that's why we don't know yet. You know what, Mark, we will know is if support holds this week or we break out of resistance this week. At that point, you do know certain things. But as of right now, you have a bullish retracement on the day on the weekly chart and a bearish retracement on the daily chart. I'm sorry, but no technician in the world is going to say they have a strong opinion exactly what's going to play out right now. No, what we do know is the levels we need to achieve. And that is more important than anything that I say regarding my opinion of something. What I do know is this: confirmation is a technical concept that occurs in a retracement when you achieve a close above the previous candle. So if we're looking at a flag-based pattern on the S&P 500 right now, and we're looking at bullish retracement-based patterns on the diamonds on the weekly, bullish retracement patterns, choppy and deep, but bullish retracements on IWM on the weekly, and I would say RSP killed the pivot and is in some degree of neutrality at this point. But if we're looking at those deeper bullish retracement on weekly charts, you're going to have to see reversal formations on the daily charts, and navigating the bearish retracement is the first pattern that develops within the overall construct of a reversal. Ultimately, Mark, I think we reverse here. That's my base case. I think we've seen the biggest damage from a technical and a fundamental perspective. I think we start finding some consolidation at the low point on the cyclical side of the equation. You just have to navigate that ultimate bearish retracement, Mark, because it is equally from a probability perspective. Again, regardless of what I say, this is one leg down, this is one leg up, which means you're going into, based on any degree of trending analysis, you would assume you get a C in the correction. Does that make sense?
Mm-hmm.
Assume, based on pure technical formations, that you would get another leg down based on the overall environment. The short-term trend is bearish in the cyclical areas. The pattern is a bearish retracement. You now have two legs in that short-term downtrend. According to Elliott wave theory that has been documented for over 100 years, the ABC cycle is 3 waves, which means you would technically be expecting one more wave down. Is that a bearish take? Maybe, but it's also a very consistent technical take. That has to be worked out before everybody gets excited about blood in the streets, go out and buy.
Yeah, no, and and I am 100% right on board. And I know from a tactical perspective, I'm just trimming, right? I'm getting lean, I'm getting mean. We use the phrase tackle trading volatility playbook in these type of technical situations, and everyone's volatility playbook is a little different, but it does mean you're approaching the market from a different perspective, from a tactical perspective, than you do at other times, right? And for me, that get lean, mean, raise cash levels, get those covered calls, right? Working
that theta score, guys.
Even if you are not a cash flow addict like myself, this is a time where that knowledge is really, really beneficial, because a lot of people have holdings that are in situations that haven't been ideal in the last 3-4 weeks, right? That's covered calls has helped mitigate, a lot of that damage. By
the way, we're talking on the macro side of the equation. This is a trader's market. There's still good bullish trades out there. There's really good bearish setups right now. And so, and ultimately, and we don't need to stay on this topic too long here, Chucky. I mean, at the end of the day, navigating reversal, I call it the art of the reversal for a reason. I've done the art of the reversal webinar many times at Tackle Trading over the years. It's an art. There's part science, there's part art. We're in step 1. as this develops, whether or not we see the ultimate development of a reversal pattern here, or maybe one more leg down, it will represent a buying opportunity. But you got to see that come to a conclusion, is my only general point. Technology leading the charge right now, but again, the cyclicals have an opportunity only in reversals, in my opinion. And by the way, there's 3 types of reversals.
All right, let's get into some predictions.
All right.
You whooped my butt last year, and I
honestly don't know what whooping your butt means, because,
well, it means
that could mean I just beat you on 1 point.
Well, that just means you beat me, right?
Okay.
But you beat me pretty soundly, and I am a very competitive individual. I come from the same bloodline. And I have, I've said we're always every year, like this time, right? You reflect on goals. I've really spent the last 6, 7 months trying to improve my overall analysis, my overall trading, how I approach, that's what we're always doing, right? We're never the final perfect version. But enough of that blah, blah, feel good, kumbaya stuff. Let's get into some predictions. And what we're going to do, we're going to walk through 8 areas of the market, Matt. We're going to review what we thought, what we got right, what we got wrong, kind of little mini review of 2024. And then we're going to talk about that area.
So we're going to review the prediction from last year and then give our prediction for next year.
Yes,
with each segment, correct.
And we're going to go over the dollar. We're going to go over sectors, gold, oil, commodities in general, the dollar, Bitcoin, and then the Federal Reserve.
Okay.
Where we're going to end up, and we're going to start with the S&P 500.
Everybody just put your predictions down with us as well if you're listening.
And what we're doing and the prediction we're making, and we try to point the path of things as well. Is where will it end at 2025? Not where will it end at 2025, Matt? And so winning last year. I'm going to let you decide who goes first on the S&P 500, and then we'll take turns. Whoever goes first on the S&P 500 will go second on the next.
What was the predictions for the? Because again, I'm willing to bet recapping what the numbers were. Like, what were they?
You had the S&P at 5,100. I had it at 4,830, which were both on the low side. Yep. Pretty general consensus Wall Street chalk numbers, plus or minus, generally on those numbers. Wall Street was not terribly bullish heading into 2025 in the sense of, big, huge, gigantic predictions. Market, has a humbling effect on even the best and the brightest. Both of you and I, when we were discussing 2024 heading into it, saw a stronger economy, saw stability, saw a good cash flow environment.
I think I was like 10% is what I expected. Is right around a 10% growth.
Yep, and you thought it could go as high as 5,500. Overshot that a little bit. But 2024 for me, the thing that I learned the most in 2024 was I underestimated AI. Now, fortunately, I have a brother that I consider an AI expert, and the leading expert, when it comes to market intersection with AI. Right. Man, you did a lot of AI specials. We talked about AI on the podcast, right?
Maybe we did 3 of them last year.
Yeah. And I incorporated that more and more into my decision making to get more and more bullish as the year went on, right? Adapt as you go. But, I think I completely underestimated AI heading into the year. I also think I underestimated Janet Yellen in an election year, to be frank.
I think that's as big of a one as the AI, quite frankly. I do think a lot of people underestimated the AI, and even 3-6 months ago, people were still underestimating AI. By the way, people are still underestimating AI.
That came into my analysis, right? We'll get into that here in a second.
It's still happening even right now, despite all the vast evidence of notwithstanding, it's still happening here today. But I think Janet Yellen, I think there's going to be research papers and books written on things Janet Yellen has done over the last 4 years, quite frankly. And I don't think we're talking about a market at 6,000 without Janet Yellen.
No, you are not
doing what she did this year. And while people might be saying, well, what did Janet Yellen do this year? She's Treasury Secretary. Janet Yellen had her greedy little fingers in every aspect of monetary policy this year. In fact, while the Fed was raising interest rates and talking tough on inflation, why we have been sticky around 3% for months and 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 months is because in the back door of the monetary cycle, you had entities really kind of lowering the monetary threshold. And Janet Yellen was doing a lot of that underneath the surface, quite frankly. And so I just feel like the battle against inflation really took a stop about 6 months ago, Mark. And even though the Fed continued to talk tough, and even though the Fed had a higher than a restrictive, they were in restrictive territory, on the other side of the equation, they were funneling money into the banks nonstop for months.
The amount of liquidity Janet Yellen interjected into the marketplace.
Let's not call it quote unquote QE because it was direct stimulus without expectation, but it had a very similar impact. It, number one, supported the market. The Fed put was in the market for a lot of the year, quite frankly. That was not Jay Powell, that was Janet Yellen. And so I do think, AI, even I underestimated the growth opportunity on AI this year. And I was one of the early adopters. But I don't think anybody anticipated what Janet was going to do this year. And I don't think anybody truly does understand specifically everything Janet did this year. I think we all just know Janet did a whole lot of shit this year.
Yeah, no, I mean, this was an election year. Janet Yellen was not going to allow.
She had one job: hold up the market,
hold up the market, hold up the market, hold up the market, right? And she did. She did her job. She did her job.
We're all going to have to pay for that job well done there, Janet, because now the Fed can't lower interest rates as aggressively, and now we're going to have to deal with a lot of sticky inflation for an extra 18 months. So congratulations on the 6 months. Good job, Janet. Now we're all going to have to pay for your sins for the next 18. But yeah, I think Janet deserves a lot of credit for the market performance this year in totality.
Yeah, no, and so as we head into 2025, do you want to go first or should I? And then we'll take turns after that.
I won, right? I get a pick.
Yep.
You go first.
Yep. I go first.
Yeah.
6,700 will be my final prediction with a cap over 7,000. With 5,200 on the low side. Coming into the year, bullish, even if there are things. Now, there are, I tend to look at things, glass half empty, right? I am concerned about valuation. But I thought John Flood from Goldman Sachs had a really good quote when he said, listen, valuation is a top concern by market skeptics, but bears are going to need either earnings or economic data to take a turn for the worst. And that's generally how it goes, right? I would throw in there.
When was the last bear market that started based on valuation concerns?
It doesn't matter, right? And so
start economically, they start something.
We all get that certain areas of the market are very frothy. Other areas aren't frothy at all, right? As we start the year, they're either undervalued, small caps, energy, materials, reasonably valued, finance, health. I mean, valuation from a sector level, basically when people talk about valuation from a market perspective, we got some frothy stuff related to those AI names, and for good reason, right? And that lifts up the overall numbers. But I look at finance, I look at healthcare, I look at energy, right? I don't see insanity. Right. I don't see insanity. And so I think you're going to have, I think John Flood's right. I would throw in monetary policy here in a second, that you're going to need either an economic or an earnings. And on the earnings front, I have given, this is something I said in the podcast last year in this prediction podcast, I am giving companies the benefit of the doubt. And I remain that heading into 2025, that higher interest rate environment, right? Companies are ran by really smart individuals, right? Who know their businesses, who don't just think of today and tomorrow. They are forward looking in their decisions, giving companies the benefit of the doubt. I'm going to have to see an earnings recession. I'm going to have to see slowing earnings growth. And I'm going to give the companies the
I have to wait a few quarters because nobody's seeing that in a
exactly. And so
25.
that would be a reason to cause bearish conditions. Another reason would be the economy. Plain and simple fact is the last few years, we have ran in wartime spending numbers, right? The amount of money that the government spent has been astronomical, other than these, crisis level events. I don't see that changing under Trump at all. I think Trump is going to want to run the economy hot. In fact, Scott Bessent, new Treasury Secretary,
they've been very, very clear on they're going to focus on growth.
They're going to focus on growth. We're going to grow our way out.
When the government says they're going to grow their way out of something, they're not looking to cut spending. They're looking to invest so that they can grow their way out of certain things. I just wanted to add on. I'm sorry to.
Oh no, this is not a diatribe. It is it's a conversation, right? So you don't see it on the earnings, right? Like, what are the things that cause a bear market? You don't see it on the economic, growth. The economy is going to run hot. The economy is going to do just well. Now, what are some other things that might cause? Well, obviously, we start the year with yields. And this is one of the big wild cards coming into the year, right? Yields, dollar. We'll talk about these more in depth. So I'm not.
Can we take a step back real quick, Chucky?
Yeah, of course.
Because like you are going to have the same talking points I'm going to have, right? Mm-hmm. On the economy, inflation, kind of the overall landscape. And so if we can take a step back on the economy here. Mm-hmm. Economically speaking, in the dot plot, the Fed was expecting the economy to continue to do what it has been doing, which is between 2% and 3% this year, GDP growth, correct?
And Scott Bessent had, in his 3-3-3 plan, 3% growth is their target.
So they're targeting 3%. The Fed is expecting somewhere between 2% and 3%. I think both of us expect the economy to continue to be a bullish narrative, correct?
Yes.
Okay, so we're both on the continuation of the bullish economy, and
I don't think this is a hard call coming into this year.
I don't see a lot of people anticipating negative economic growth next year, for a variety of reasons. Could inflation be stubborn? Absolutely, inflation could be stubborn. But economic contraction is a different conversation than people struggling due to inflation, obviously. And so economically, I'm right there with you. I there's nothing in the central bank's projections. There's nothing in what Scott Bessent says, or looking at the Trump policies to suggest that we wouldn't be able to achieve the 2 to 3% GDP growth from next year.
Nothing. Yeah. No, they're just going to spend too much money.
Now,
right?
Obviously, there are unforeseen situations that could drive different conversations there. I'm going to throw out that variable disclaimer 14 times in this podcast. But I'm right there with you. The base case has to be between 2% and 3% growth next year.
Yeah. All right. Okay. And so you
also mentioned earnings.
Right?
From the earnings side of the equation, we're actually looking at earnings expansion next year. We're not looking at earnings contraction from a base case going into next year. In fact, I would say this previous quarter, which price action hasn't been beautiful this previous quarter, but from a pure earnings perspective, we had higher earnings growth this previous quarter than we've had in the last 3 years. That's just not going to go in. And the first quarter is going to be a good reporting year. Whether it beats expectations is a different conversation, but it's going to be a positive number. The second quarter is going to be a positive number. And Mark, I was the guy 2 years ago to beat down 14 billion people expecting earnings recession. And I was the one to say, no, we are not going to get an earnings recession there. I can't imagine an earnings recession coming into 2024. And so earnings, I just don't see negative economic growth from an earnings perspective. So if it ain't economic, if it ain't earnings, then your third point was?
Well, and I'm not talking volatility. All kinds of stuff can
I expect a lot of price movement next year. Yes.
But basically federal policy, Fed policy, which relate to the yields and the dollar conversation. And I want to save most of that dialogue because we're going to talk about the Fed and the dollar at the very end. But let me be simple. If yields continue to go up, we're not going to have a bullish market. If you and it's not the guessing game. I saw Tom Lee on CNBC the other day say,
Yeah.
well, I don't think yields are going to be a problem till 5%. We don't know. I would argue that
yields going up 1 iota of a percent is a negative for the marketplace. We're already talking about higher yields. Yeah, Tom Lee doesn't need to rinse and repeat 22, 23. No, you don't need to rinse and repeat 22's monetary conversation to not get what Tom Lee wants.
Matt, I would argue that the move down in RSP and in cyclical stocks, when you track it with the movement in yields, there's been a lot of correlation in the last month.
Almost
right.
1-to-1.
It's a lot of correlation. So I would argue it's already happening. And if you go,
I just wanted to jump on that as well.
Yeah.
If yields continue to climb, the market's going to continue to struggle.
That's simple
on that. It's like, no, we're not going to get used to yields continually going up. We're not going to get used to that. We don't like it. Nobody wants it. Everybody hates it. From Wall Street to Main Street America, everybody hates that conversation. Tom Lee, the ultimate bull who just wears the bull hat nonstop, he's wrong on that. He's been wrong on that.
Now, I have a prediction of 6,700, which is a fairly robust bullish prediction, especially for me.
67 would equate to a right around 12%.
Yeah, 12, 13%, somewhere in that ballpark, a healthy year. Now, obviously, if yields are hitting 5,
book on Wall Street's 9% right now.
So if yields go to 5.25, 5.5, we're having, forbid I saw like Barclays or someone say, hey, why can't, or T. Rowe Price, they were the one that said, they could go to 6. Well, market's going to crack. S&P is going to be down to 5,100 or lower if that occurs. But obviously, I have 67, so I don't see.
Case, you're 6,700, right? Base case.
Yeah, I don't see that happening, and this is the reason. And I'll get into this, but this is part of my analysis. Is I do not believe that there is a good chance Jay Powell ends the year as Fed chairman. I believe that right now on December 8th, I believe it was, Trump said, I don't have any plans on firing Powell or getting rid of Powell.
We'll see.
Yeah,
we'll see.
Because inflation is sticky. And if you run a hot economy,
you can't yell at inflation.
And if you deport people on mass scale, and if you institute tariffs, all these are going to happen to some degree. Inflation's not going down. It's going to remain sticky. Wage growth's going to go up.
And Trump will blame Powell and want Powell to lower rates. Powell won't do it, and Trump will try to.
And Powell's gone. And so
that's the scenario where Powell gets fired.
That's the scenario, and that could be a scenario because Powell, if inflationary numbers remain sticky, all of a sudden the hawkish side, we haven't seen that side in Powell in a long time, but that hawkish side comes up, monetary policy gets tight, Powell's out the door, Fed chairman's put in that is accommodative to Trump, that is going to reduce yields, reduce rates, take the pressure off that, all other considerations. And then you add in a few
other in a year, by the way, at the Fed. The Fed only meets 8 times.
Yeah, you think Trump's going to move slow? Like
not when it comes to Jay Powell.
Other bullish factors. Yeah, and once again, I think there's going to be a tremendous amount of volatility. Other bullish factors this year include this is going to be a very pro-business. I don't know if it's going to be a pro-average human being because I don't think they're taking inflation seriously. I think inflation is going to be an issue. I don't see anything in their policies that say we're really serious about inflation. That means people are going to have jobs, right? They're going to have to fight inflation.
No, they're serious about growing out of it, and that's going to lead to sticky inflation at 3%. It's not, you're not growing yourself out at 3%.
But this Trump administration,
unless honestly, the only honest cure to this inflationary situation is AI efficiency.
Yeah, and this Trump is going to have this administration going to be very friendly for business. I think you're going to have waves of policies, that are deregulatory, that are pro-business.
Pro-business, pro-growth policies lead to sticky inflation that leads to issues between Trump and Powell. Base case.
Yeah, like so 6,700. I think you peak north of 7,000 this year.
All right,
settle into 6,700. So that's my thought process, my prediction on the center of the investing universe.
And I'm not too far too far different from you, honestly. And when thinking about what kind of the variables of what the S&P would do next year, my brain exploded on the amount of variables.
I mean, yeah, like the rides.
Exploded. Well,
This is one thing I don't think this is. You know how 2017 Trump's first year in office was really smooth, and that's not going to be this year. This is going to be
it's going to be more choppy because that year only had tax cuts.
Yeah, that's just going to
be. You're not. Obama delivered an economy that was pretty standard. 2.5% growth, inflation extremely. We were in global synchronized growth in the mid 2010s, Mark. Inflation was basically a nothing burger around the entire world. And this global and the average interest rate at the time around the world was like a whopping 2% from the major currencies out there. It was nothing. And so coming in, that first year of Trump was really just tax cuts. And it was a very consistent, robust, not a lot of volatility in 2017. I don't think you can expect that go around this time in Trump's first year. I'm right there.
It's a completely different backdrop.
Well, it's again a different backdrop, a different economic environment. And we quite frankly live in a different world post-pandemic. And so we live in a vastly different world that has vastly different monetary and economic and geopolitical situations occurring. And so I don't think, and you and I love to look at historical examples and say, this is the base case. This is what it looks like. I don't think you can say that.
It's a helpful exercise, but it's hard one for this coming year.
Yeah, it is a very helpful exercise, but I kind of feel 2016 is a little bit of a better case study. The reality going into next year is, Mark, you're absolutely right. Economically, you're probably not seeing a ton of bumps in the road. From a geopolitical situation, you probably see some slight alleviation of those geopolitical events. I'm speaking about Ukraine and specifically Israel, but again, we'll have to wait and see on those types of situations. There's obviously a extremely important Cold War happening between China and the U.S. right now that the U.S. is a little bit behind on right now. Maybe that escalates a little bit next year. When you look at it from an inflationary perspective, we're going to be having sticky inflationary conversations all year long. It's going to happen. You look at Trump's policies, obviously tax cuts are most likely going to get through. That's going to be a pro-growth. Benz is constantly pro-growth conversations. You certainly see that, but pro-growth is also pro-inflation. It increases monetary supply, increases debt, increases a lot of the things that are concerning. But once again, let's see if that can be achieved. I do have my doubts that you can grow yourself out of inflation. Inflation, when it becomes really sticky, becomes a compounding factor that I believe you have to really be vigilant to put the.
You can't beat inflation with simplistic political talking points.
No, you cannot. But when you look at the prediction, I don't think you're too far off. I think we have a good year. I think we have a better than average year, average being 8 to 10%, 8% if you're looking at cyclical, 10% if you're looking at the S&P 500. You were right around 12, 13%, Mark. I was at 68.50 is my prediction. And so I'm slightly higher than you, but again, very similar analysis, quite frankly. Not a lot of differences there. Economically, I think we hum between 2 and 3%. Earnings growth looks to be consistent. I don't have a lot of concerns. I think from an AI build out perspective, I think we're going to see a secondary scenario where you start to see the AI impact, start to see it from an efficiency perspective. Efficiencies will do nothing but help profit margins at the end of the day. And so I still think the AI build out is the number one reason why the market goes up next year. I also think it's the number one reason why the market would go down next year. It's the most important concept in terms of why the market will go up versus why the market will go down. We can talk about inflation. We can talk about the economy. We can talk about You know, you mentioned on inflation. We can talk about, all right, from a pro market perspective, tax cuts is a winner, correct?
Yes.
Okay, absolutely, it's a winner. All right. On the negative side of the equation, mass deportations is a loser, correct?
It just
Just talking markets.
it's it's a loser market perspective. Yes.
But I think the mass deportations, I don't think we're going to do, I don't think we're going to be able to achieve what others expect from a mass deportation perspective. Mark, people think governments can get a lot of things done in a short amount of time, and only in historical situations does that occur. Most of the time, when you think about what a government can do in a year's time period, you're talking one to two things, Mark. You're talking one to two big things. And if the tax cuts are going to be the most important thing, then you're talking on the mass deportation side of it. You're probably just talking about, and I'm talking specifically for next year, you're probably just talking about rounding up the criminals in prison systems around the United States and deporting them, which would have absolutely, by the way, would be the right thing to do, number one. And number two, it would also have zero impact on inflation because they're having zero impact on the economy. Does that make sense?
Yeah, that would, yeah,
okay.
Makes perfect sense.
Mass deportation in the sense that we're going to round up the farmers in Florida and California and Texas. Yes, it would have a sizable impact on the economy. And I think mass deportations would decrease the GDP by 1.2%. Okay. Which is a big deal, and it would elevate inflation. But once again, political season election rhetoric versus running the U.S. government is two distinctly different things. Agreed?
Well, you go back the last 30 elections, yes. Probably every one it always plays out that way.
So I know that the mass deportations gets a lot of talking around economic circles and the impact on inflation, but I just don't know. I just don't believe we're going to mass deport 20 million people in 1 year of time. I think that would be
the logistics seem difficult.
In fact, when you go back to the last time we did fairly sizable deportation programs, it was back in Obama's time. And Mark, what was the inflationary rate at the end of Obama's time? It was like 1%.
Yeah, it was. And deflation was the topic du jour.
It was exactly. And so they're smart people making these decisions. And again, I understand the political rhetoric side. Just from a prediction perspective, I don't believe they're going to be able to accomplish that, even if they wanted to deport the mass deportation number. I think they're going to stop short, deport criminals, focus on getting tax cuts, and get this economy up and running the way it should. And if that is the case, we might be low on our projections. You could see above 7,000 if things kind of turn the right way here. It would not be shocking to see a second. Well, this would now be the third year of the AI build out. Going into year 3 of the AI build out, it would not be shocking to see a 20% clip on the S&P, but I'm going to stop short. I think we are volatile, but I will say 60, 6850, 14%. So I'm around 13.
Yeah, we're so volatile that rally to 6,800 might start at 5,200. But
I was close to going first quarter contraction into second quarter upward movement in price. The point on the political conversation is this: it has a sizable economic impact that we do not know exactly how these policies are going to play out from both a tariff perspective and a deportation perspective. Tariffs, can they be inflationary based? Mass tariffs will be. Mass deportations will be. I just believe we're going to stop short of mass tariffs, universal tariffs, and I think we're going to stop short of mass deportation.
Yeah, bottom line for me, this is a very pro-business administration. Mm-hmm. It's just not a lot more complicated than
they're going to do everything they can to grow, baby, grow.
Yeah, they are. All right, best sector, worst sector. Last year, Matt, you had communications as the best sector. Really good analysis on that. I was let down by OPEC. I had energy, which was a terrible call on my port. Several things I got wrong on that one. I thought that China would move faster. I'm still going to have a lot of very,
You
very
can blame China.
favorable things. China was slow as
Very
molasses.
slow.
Only started getting going in the last couple months. Really, really slow.
What's your question on China?
Oh, I got a lot to say on China in this podcast later on.
They made historic mistakes from a growth perspective over the course of the last 4 years.
Okay,
not
yes.
to debate COVID. I'm just saying from post-COVID, every other modern industrial economic system out there opened up years in front of China.
China is an area of the markets that I know better than most. I study it more. I believe that they were far too hesitant, worried about perception coming out of COVID, right? They were getting a lot of blame, right? They're like, hey, you started this. They probably did, right?
They lost 14, okay. If we're talking about China versus the United States going into the pandemic, it was a close race economically. The U.S. was still better, but
it was a genuine battle.
It was a genuine battle, though. Post-pandemic, supply chains obviously shut down, but it was really China not opening up that was the problem. Mark, I believe they stunted their growth by 2 decades.
They did, and I could, I think there's lots of reasons they did. I think they felt responsible. They didn't want to go too fast and all of that. But they have been, bottom line, really.
They didn't want to let people know the origins of COVID.
Yeah, they've been really. I mean, that's just really what it comes down to, right? They've been very, very slow. In that. Now they've picked that up and they're accelerating the last couple of months. When we talk about commodities, I'll talk about that more. But also OPEC. I had the OPEC having your back valuations. I had a strong economy. I thought you'd have OPEC have your back. I thought low valuations coupled with China would provide energy. OPEC did not have your back. They turned mid-year and basically killed the potential for anything sizable happen. OPEC changed basically the policy.
If this would have been a first quarter prediction, you probably would have nailed it.
I mean, it started out good. I was feeling really, really good about my prediction, because I mean, it started out those first few months. I was feeling very smart. And then, things changed. China went predict. OPEC got involved.
OPEC was the biggest problem, child.
And then of course we've had this sell-off and everything was been dramatic, but it wasn't a bad year heading into the last couple of weeks on energy. But I got that one wrong. You got your communications right. Completely. You're out.
But I'll take the Bernanke on this one. Comms and tech were comms and tech. What was comms 35% this year? Tech 37 or something like that.
Yeah, and so heading into this year, you go first. And then on worst sector, I had staples because I had, high valuation on defensive areas. You had utilities. We both didn't have that. Yeah, but we both had defensive sectors because we both had this bullish lean coming into the.
Well, and I said utilities, if you correct me if I'm wrong, due to defensive and valuation issues.
And so this is one I got you. I don't
until utilities decided to be tech. Techs. What would it be? Utilities would be like a AAA baseball club for a major league club. Utilities to tech. All of a sudden, it's performing like tech, but yeah. So I'm first on the predictions.
Your prediction, best and worst sector this year.
This one's tough for me. And the only reason it's tough is because I want so badly to pick energy. I do. And if I was going to pick just cyclical sectors, I would pick energy in cyclical.
Yeah, and I understand where your head at because I told you this administration, once again, this administration is going to be very
deregulation environment and energy
policy friendly towards energy companies.
Yeah.
Right?
So I want to pick energy. If it was just cyclical, I'd pick energy. If it was just defensive, I'd probably pick utilities because utilities kind of gets that tech bid. But I think year 3 of the AI build out, I think AI still leads.
Yeah, me too. That's my pick too. I like.
So whether you
It's
want to
just
say
that simple.
comms, they're both going to run together because the leadership of tech and the leadership of comms are all run on kind of the same gasoline. But I would just say I think AI for the 3rd consecutive year leads the charge. And by the way, I have this as a 7-year build out. We're going into year 3. I think Mark, a year ago, I think we were talking AGI that
Matt,
like
XLK took the last 8 months off.
I know.
Heading into the year.
I know. But it does have valuation concerns.
Yeah.
Obviously a 40 PE ratio will do that. 20, I think it's like 25 on the forward PE ratio, but I just think the growth environment plays out here. And I think on AI, if you want to talk about energy and deregulation and pro-growth, Trump administration pro-growth on energy, what's Elon and the tech bros going to be? Anti-AI development? They are doing everything in their power to create an environment where we win.
Silicon Valley back Trump. They're going to have a seat at the table.
Well, they do have a seat at the table and a big seat at the table. And the reality is, Mark, I believe in the Cold War between us and China, that part of that Cold War, and it's vitally important for us to win the AI build out. It is vitally important for us, historically speaking, to win this AI war in terms of the build out with China. And we need to throw the kitchen sink at that one. And so I just feel like the tech bros are going to influence the Trump administration. And when I mean the tech bros, I mean, there's quite a bit of them. Even Bill Gates, even Bill freaking Gates is down at Mar-a-Lago just yesterday, Mark. He's not one of the tech bros, but obviously he's Microsoft giant, right? So obviously there's some things happening there. But it is important for us to control this AI conversation from a historical national security perspective. And I think Trump does understand that. And I think Trump understands that a little bit because, the tech bros are forcing that conversation to a certain extent. And so I think you're going to see lack regulations. You're going to see aggressive build outs. And I think that pro-growth environment is going to do nothing but see further continuation of the CapEx spending of these mega cap giants out there that are spending billions and billions and billions and billions of dollars on trying to get first position on the AI. Mark, this is a race. In these races, people aren't going to stop short. So I'm going to go with tech. Tech comms, 1A, 1B.
Yep. Worst sector. I'll throw mine out first. Healthcare for me. When you look at the pro-Trump policies, you can see cyclicals. They have, wonderful things all over them. You see technology, all of those. We just talked about that in length.
And so with energy on the cyclical, the best sector on the cyclical is energy, probably.
Yeah, finance would be an argument. Would be an argument.
I just like the valuation on energy slightly better than finance. And going into the year, I kind of like energy at the low point versus finance kind of hovering at the high point a little bit more. But yeah. All right. Worst performing sector, what'd you go with?
I went with healthcare. Whether or not Robert Kennedy gets confirmed or not. I don't think there's a lot of love for pharmaceutical companies in this administration. I think it is the
companies.
Healthcare companies in general. And so I think
you're not going to get disagreement out of me. I was wavering between healthcare and a couple other, but healthcare, you convinced me. I'm jumping on your freight train.
Yeah, I think this is an easy call from just a conventional wisdom standpoint, and for predictions, unless you have a strong, opinion.
I don't have a strong opinion on the worst.
Conventional wisdom is probably not a bad place to be.
I have to have an opinion because we asked the question. So here's my opinion. I agree with Mark. That's how detailed my opinion is.
All right, let's go to gold. Both you and I were almost identical in numbers and in the general thought process of gold. We both had it. You had it at 2,300. I had it at 2,250. We both had, Fed rate cuts, inflationary pressures. We both had and this was key for both of us. We both had it stabilizing over 2000, because I know that seems like ancient history, but gold had never stabilized heading into the year above
This
2000.
is the first time it's ever done it. If this is the first time it's ever done it, and both of us were predicting that, and yes, we were. I remember that conversation every single stinking day. We dialed that in.
Here in the podcast for months, it was like, as soon as gold stabilizes over 2000, 2000's the new floor.
It's the new floor, and 2000 proved to be the new floor. It had a great year. Gold had it was one of the more consistent, better performing assets. It's ending the year on some chop. And yeah, am I impressed it's held up in the face of the dollar rally? Yeah, but it's still ending the year in some chop. And so did you give your prediction, or is it my turn?
It is my turn to go first.
Okay.
It is my turn to go first. And so we had a tremendous year. And, this was probably the toughest one I had. My market analysis sector, some of the other things pretty much fell into line, especially once I decided
that Powell's 13% upward movement.
The second I decided Powell's getting fired,
going down.
The second I decided Powell's getting fired, everything. And so love gold long term. I believe that those inflationary pressures are there. I believe that is a benefit over time. The 70s taught us this. Other time periods have taught us this for hard assets, right? Hard assets benefit in inflation. They tend to outperform. Commodities had a stellar 1970s, and I don't think we're going to repeat the 70s. Once again, too many different things happened in the 70s, but you get my general consent. During these times,
didn't have AI.
During these time periods, right? They're inflationary aspects. Goldman Sachs had a stat out a couple weeks ago, or it was a week ago, 10 days ago, somewhere in that range. And, every news thing falls under the radar in the holiday season because, people are checked out. But they said that China has been buying 10 times more gold than officially reported. And so, and we know Russia, we know China, we know other central banks, gold is being purchased.
They want to have gold as part of as a reserve.
And so, that's trend is not going to slow down. It's gonna, continue on that. I don't think Trump, if you remember gold's price action, Trump causes volatility.
I don't think you're breaking any news here.
Right? And Trump causes volatility, and gold tends to hold up in volatile times, right? The dips are more shallow, the lifts are stronger, right? Whether it is trade wars, the gold tended to do very well during that time period under Trump. And so I think you have all of the things that make gold ownership attractive, a basic what we've been arguing for years and years and years. I also don't have fiscal spending coming under control anytime soon. And I think I think you're going to have China go further into debt. More on that in the commodity section when we talk about it. I don't think this administration, much like the last administration, will be remembered for their fiscal responsibility. They might have some nice talking points, but at the end of the day, they want to grow. They want to grow.
Our national debt in an 8-year time period that took 220 years for the first time to do.
Yeah. So
in the last 30 years, don't get me started. They're not fixing the debt
problem. So Trump first administration, Biden's administration, Trump 2.0, it's all about spending money, right? That is a constant reminder, and I think for everyone, about the fiat nature of currency. And whereas hard assets, gold in particular, is a natural hedge against, let's be honest, one day the bill's going to come due. And when that bill comes due, whether it's 6 months from now or 16 years from now, well, that's a whole different conversation. But it feeds into the argument of gold ownership, right? Whether it is actually true one day or not. the analysis is the same general supportive analysis that I've had on gold for years, right? And now, so what do you do after gold's ran for 10 months? Do you have a correct? And this is where it gets tricky for me, right? Because you have, a pretty decent argument. Where do you do from an extension? I'm not going to overguess it. I think you see 2,900 at the end of the year. I think you have a decent year in gold. There could be volatility with yields, and then once again, there is my hedge of the podcast, right?
Could have volatility in yields.
If yields go up, we saw in the summer of 2023, gold was not immune when volatility hits everything, right? When it hits everything, but it was very, very quick to recover.
In the 2010s, the phrase global synchronized growth became the whole talking point, right?
Oh, it's a great thing.
In the 2020s, it's global synchronized debt. And that's not
clever, actually.
Stop.
Okay?
And so if you can tell me when that stops,
it's not stopping.
I will stop predicting gold going up.
It's not stopping.
It's not going to stop. We don't need to get into the micro concepts of what Trump will do here or Trump will do there or what this economic policy would impact. If the global synchronized debt expansion doesn't stop, gold won't stop either. And I'm sorry, I don't think it'll stop until somebody forces it to stop. And that's not based on what we're seeing in the world today. So I just feel it's, whether or not, I fully expect gold to have complete. I wouldn't be surprised to see a complete quarter where gold does nothing but neutrality, right? Mm-hmm. I wouldn't be surprised.
No, that's what you saw last quarter.
Well, and I wouldn't be surprised if this entire year in 2024 or 2025 is determined by 2 or 3 different legs in the market, and that's it. But in gold, I see this at about 3,100. I think we break 3,000 this year. I don't think we stay above it the entire time, but I do believe we break 3,000. I do think it basically will hover around that 3,000 level back half of the year. And I think by the end of this year, we achieve the first break and close on a yearly price on gold above 3K. So I'm going to go above 3K.
All right. Oil, you go first. And once again, you and I, we're going to do, we've been pretty chalk aligned with each other. This has been very unexciting.
We talk a lot.
Well, it's almost like you and I have constant conversations every day.
Talk a lot. Well, Mark, if you're a top-down analyst, and both you and I are top-down analysts, we're going to anchor against certain macro conditions. And if those certain macro conditions, we're reading them similar, we're going to have similar takes, right? Maybe we diverge here on crude oil. I do believe crude oil goes up this year. I am most.
We're going to diverge.
Yeah, I have most things.
I got a conspiracy theory.
I would have been shocked if I saw that. Now, drill baby drill is going to open up the floodgates, right? And it will cap performance, and we'll have to see what OPEC has to say about that. But if OPEC says we're going to open up the floodgates as well, you might get 55 on oil, no doubt about that. But I'm going to say support holds. I don't have a strong opinion here, Mark. I do think the economies around the world are in that 2% range. And so I don't see a tremendous amount of growth for crude oil, but I will say 75 by the end of the year.
All right. I am going to say 57.
I thought you were going to be in the 50s here.
All right. Here's my theory.
Here's why, though, because he says 75 against 70. I don't have a strong opinion.
All right.
You do.
So on the bullish side, right, you have China. And I'm going to get into this more in commodities. But
China's economy opening up. Yeah.
They are committed. They're slow. They're
the most committed turtle in the history of turtles.
That is a great saying. Gosh, why didn't I think of that?
Yeah.
They are slow, but they are steady and they're increasing their pace.
They're a sea turtle.
That is pro. Go on the pro side. The Trump administration has not so quietly had a lot of Iranian hawks, having a seat at the table.
Really?
Here.
A couple.
And so
they should have Iranian hawks.
So conflict with Iran, even if it's not direct military conflict, is a certainty, right? And that is pro oil, right? Because in some way that could curtail,
bullish for oil.
Curtail the thing. And you're a little blurry on the podcast all of a sudden. I don't know what.
Yeah, don't worry about it.
Okay, I won't worry about it. So there's that. OPEC on some level, right, is going to try to stabilize price, even if they've really not the OPEC that came into 2024. So there's some pro things. We're starting with the supply glut, right? This is an issue. Global economy in which oil is measured is not fancy free. I expect China, US to do their part. But why I am really predicting lower prices in oil, it comes down to the Scott Bessent 333 plan, right? The increased energy production by 3 million barrels per day. If that occurs, you're seeing the 50s. If you're seeing, you can forget about high yields. You can, and not that oil is the only inflationary component.
Wait a second, hold on. He wants to increase by 3 million barrels
per day.
That is a big number.
That is a huge number. Now, the Exxon Mobil CEO came out and said, "You guys are smoking crack." Now he did.
They hit that number.
He said, once again, political talking point, but the Exxon CEO is like, "There's no." Because companies are not going to just lose money to appease an administration. That's not going to happen.
They'll crash oil.
They'll crash oil.
Yeah.
They'll crash oil. Anything approaching that number will crash oil. We're already starting the year in a supply gut.
If you crash oil, you will ultimately crash other things.
You're going to see oil subsidized by the U.S. government, energy companies to produce more.
What?
I think you will see that this year.
Oh, coming with the wild card prediction, subsidy of U.S. shell companies,
because companies. Okay, fact. That hurts. It's not as
capitalistic heart there, brother.
But it's not as crazy as you think about it. Fact. They want to increase production 3 million barrels a day. Fact. Companies are not going to do that voluntarily. They'll lose money. It's dumb. What's the solution?
Not without other
incentives.
Yeah.
And the incentives can't just be, we're going to give you a tax break. All right, I'll give you $1, but you're going to have to lose $4.
Yeah.
In the process. U.S. government subsidize U.S. energy producers to produce more oil. That's my prediction. And that's why mid-50s is my prediction on oil.
I don't know what to say. I was not thinking about that at all. I'm going to go ahead and disagree.
It's an out there prediction, right?
Yeah, but I love it. I love where you're going. I love whatever you ate in your Wheaties today. I need this every week on the podcast. This is great. I love this openness you're bringing to the predictions. I love this conversation. I do not believe we subsidize energy companies this year. That would be I think you would lose so much political credibility if you subsidize to that level.
I think they can sell it.
You can sell it on farmers. Like,
we're lower gas prices.
Subsidize the energy companies like we do farmers.
Yep.
I don't know. Maybe. But then again, I believe we embrace some degree of general income in the next 10 years too. That's my outlandish prediction, by the way.
Yeah, we're just going to start with corporations first.
Yeah, we're just going to say, well, we're America. That's what we do. All right. Okay, so you're at 50. Did you say 57, 58?
Yeah, somewhere in there. I can't remember. It was mid-50s. Mid-50s.
Okay. All right, next.
Best performing commodity. I'll start. Obviously, it's not going to be oil for me.
No, I wouldn't say it would be.
All right. Gold it's not, because I have a modest increase. Listen, China is, what did you call them? The most motivated turtle in the history of, something like that.
The slowest turtle in history.
Anyways, they have done things in recent months to speed up that pace. I'm going to go copper. Went copper last year. You went copper last year. We both went copper last year. I love that basically you took the year off, right? Year early, you're about where you were. Once again, a prediction that looked genius 5 months into the year.
Oh, we were so on point.
We were so on point on the analysis. We saw copper going up.
Lord Almighty, we were on point.
We were on point. Copper went up 25% at the start of the year, right? We were right. It's just the prediction's not for the first 5 months. And so, but we were right on the analysis. The same general analysis is going to play out here, right? China's committed. US is committed economically. Copper is used in AI components. It is a sneaky AI play when that train gets moving. There is a really strong case, but it is China's committed. You see the M1 money supply in China go up. You see the monetary policy shift to the most loose monetary policy since the financial crisis. You see the stimulus and the physical spending. You see every aspect, not just make small jumps in the last 2 months, noticeable, oh my goodness, we haven't done that in years or decades jumps. That's supportive of copper. General economy is supportive of copper. You don't have any supply issues with copper. Dr. Copper, best performing commodity. We were right for the first 5 months last year. And then
what was it? It was gold, wasn't it? Wasn't gold the best performing commodity asset last year? Of
yes.
The course.
Of the ones that yes.
Yeah.
Gold had a fantastic year.
Okay, so you're going with Dr. Copper.
I'm going copper again.
Chinese stimulus and all things open up and open
But
up.
I also love silver this year. Okay. I also love silver this year.
Well, and I'm going to take a little bit of a side turn here because I don't disagree with what you're talking about. I don't disagree with what you're talking about China, but I am going to say the China's a little bit of the boy who cried wolf on the reopening of their economy. I've heard it for 18 consecutive months. We're going to do this, and this. And yes, they always do something, but then they always stop short of the ultimate bazooka, what they need to do. Right. And so, yeah, I'm right there with you and I don't disagree with it, but I just can't trust China. I just
get it.
Don't trust China. In fact,
that's been a good bet.
It has. In fact, Mark, I just got done with the Tackle 25, and usually when I say I just got done, usually I'm making like 1 to 2 modifications of changes, right? But 98% of the list are done, and China's always had an influence on the Tackle 25. There's always been 1 or 2 stocks there, one stock there. I removed fundamentally really solid valuation companies due to my lack of trust with China. I think it's extremely important that we are aggressively competitive with China on the AI front, and quite frankly on many other fronts as well. So I have caution here with China. So I'm not going to go with China, but I am going to go with something else that has something to do with the exact same analysis, and you just kind of stole my thunder. I am going to go with silver, and for similar reasons, but I like silver's obviously.
Yeah, I thought that's where you would go, and so I had to front run you.
Yeah, I and you did. But I thought copper, I thought silver, thought gold, thought all of them, but I'm going to have to say silver. I actually think silver outperforms gold this year. And
I do too.
I think the GS ratio will improve on silver side of the equation this year. The GS ratio is elevated historically right now. You're also obviously any Chinese opening theme is going to impact copper primarily the highest, silver secondarily there. So obviously silver would get a bump up on that if you're right on the Chinese analysis, which again, they've been trying to do this. We'll see if they can actually achieve it. But I also just kind of I just like the commodity side of silver right now. I ultimately look at kind of the environments from a gold perspective, and I look at gold, for example, and gold has done. You're sniffing all-time pricing here on gold. Obviously on GC you have gold. What was the high price? 2,800 this year was kind of the highest price this year. I do think it sniffs 3,000 this year, maybe slightly under, maybe slightly over, but I do think it sniffs 3,000 this year. I actually think silver will outperform that. When you look at silver on a longer term trajectory, Mark, silver is significantly underneath kind of those all-time high prices that were set all the way back in 09. In 2010, after we embraced quantitative easing and, monetary cycles. So are we going to get that this year up to 45, 48? No, I don't think so. Not without substantial, monetary intervention. But over the next couple of years, yeah, I do think that can be achieved. So I'm still looking at the $30 handle ultimately as the ultimate area of resistance on silver, but I do believe in the catch-up silver storyline. And notwithstanding the last month of cyclical nonsense, I like it coming around the 200-day moving average. So I'm going to take silver. I don't mind your copper call out.
I love them both. I like,
I'm going to take silver.
I love every commodity that's not going to be subsidized against by the U.S. government.
I still think you're outlandish there.
Yeah.
I love the prediction, though.
So, dude, that's not even my most outlandish prediction. That's coming up.
All right, let's hear it.
All right, let's go to Bitcoin first. I think it's your turn.
All right. I got Bitcoin going about the same percentage as gold. I got gold slightly outperforming Bitcoin next year. I think a lot of this deregulation movement is priced into the current price action. I think it's going to take a little bit of time to kind of digest that. But ultimately, I think Bitcoin finds its footing. I think the deregulation argument that we talked about with energy, that you talked about a couple other areas of the market, I think it is real here in the crypto space. And so I do believe in the deregulation argument. I do believe in the mass adoption argument as well. Both are bullish themes going into 2025. I just feel like the last couple months will take a little bit of time to get digested. Ultimately, I think we're up about 25% this year. I got us ending at about 120 on Bitcoin.
175 on mine. Listen, don't overcomplicate
Mass explosion. This. I love it. Go.
No, I think I am being conservative.
Then what am I?
You're a pansy wuss little ninny child,
like the cash flow trade.
Do not overcomplicate this.
I love this.
This is a Trump scoreboard chart. When Bitcoin broke 100,000, he put a social media tweet out and said in Trump arrogant fashion, and people love that about him, they hate it about him, but he said, "You're welcome." Right?
Not wrong.
And he's not wrong.
To 100K.
But the fact that he said you're welcome.
He now has a target at 100.
He has a stake in this. He has a stake in Bitcoin. Mm-hmm. And if he is out there saying you're welcome, well, if Bitcoin goes to 75,000,
you need a Bitcoin. You need the U.S. government to embrace Bitcoin as a reserve to hit that number. Sure.
And they will. This is a scoreboard chart. This is a scoreboard chart for Trump. Do not fight the most powerful person outside of Janet Yellen in the world, which is the U.S. president. And now Yellen's gone, so I guess that will be Trump now. But
again,
this is a scoreboard chart for him. It's that simple.
That makes sense to me. Trump cares about these things.
He cares about these things.
Absolutely.
And if he's saying
I do like a president that does care about asset prices. I do care.
And so when he says you're welcome, he wants this to go up.
All right.
He wants this to go, and don't overcomplicate that. It's going up. Just if you get technical signals, add. That's simple. You add on technical.
No, honestly, it went from 40K to it'll land around 100K. You're less percentage wise than that.
Yeah.
Not
I think, and once again, I'm not a parabolic chaser.
You are more conservative than what Bitcoin has achieved in the last 2 years.
Yeah. And you have a U.S. government, so yeah,
talk about
175.
embracing it as a reserve. If they create a reserve fund for Bitcoin, that's certainly a catalyst. I did not expect you to be that bullish on Bitcoin, but it makes some sense.
I am almost always. I was very bearish on Bitcoin, not in the sense of long term, but like you had, institutional powers fight. I'm a huge institutional powers guy at the end of the day, because that's a pretty good bet. Like, what do the powers want? Right? They wanted asset prices to go down in 2022. Guess what? Asset prices went down in 2022. They wanted them to go up last year. Guess what?
They went up. Yeah.
Trump wants this up.
If Trump wants this up, he's going to get it up. The only thing about it is, like, by the end of the year, that's a big number. But again, like I keep saying, it's a big number, but it's a number that has been achieved by Bitcoin over the last 2 years. This year and last year both had higher percentage gains than what would that be? $80,000 gain.
And you had Gary Gensler, little weasel, fighting it the whole time.
Fired that man in a heartbeat. Gensler, it's so good to see Gensler gone from the SEC chair.
All right.
Last prediction. Are we in last?
We've got two more. We got the dollar and we got the Fed. Where's the Fed going to end at the end of the year on the thing? Matt, I got to go first, but I'm going to ask you some.
Hand in hand here.
Yeah. And so this is kind of, in fact, we'll just kind of tie this all together into one conversation since they're both. Matt, what sends the US dollar up? You are a currency expert by anybody's standards. What's
higher interest rates?
Higher interest rates, right?
Positive economic activity.
Positive economic activity, right?
The two core reasons are positive economic activity. The dollar will go as the economy goes. That's but secondarily.
What happens when the economy's doing okay, but interest rates are going down? Doesn't happen very often in history.
The economy does okay, but interest rates go down, dollar goes down.
Yeah, I have the dollar going down.
Yeah. I think that has to be base case. That's my base case personally. I got the dollar range bound next year between basically 100 and 110, basically range bound. I think we settle around 104.
Yeah, I got the dollar coming out. This has been a nice momentum run, and it's taken its course, right? And can it go parabolic from here? Sure, but I just don't see that. And this goes into the Fed.
They went from, in that time frame though, Mark, they went from declaring victory on inflation to be extremely concerned about inflation. That's not going to rinse and repeat that type of cycle next year.
Yeah, and I understand there are things that can pressure the dollar upward here and all that.
Of course,
but sure, blah 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 blah. I have the dollar down, which I think is supportive of everything else as well, right? I mean, I'm bullish on other things. Obviously, I don't have the dollar ending at 125 this year, or else all my other predictions would be much different.
Listen, I did my dollar
because if the dollar does not go down to this, just forget everything I've said except for oil.
If the dollar continues a bullish trend all year long next year, we're talking about being wrong on everything
except for Bitcoin and oil. Bitcoin, Trump will just buy it and they'll subsidize that, so that will change that. And this gets into
if the dollar continues to do nothing but go up, they might have to subsidize oil. Chucky, on the dollar here, you're absolutely right. I just kind of feel like we kind of end in a range bound against a lot of other currencies next year, which also probably both means on the yield side of the equation, we don't think we both agree they're cutting next year.
Yes.
Okay. The ultimate question is, do you agree with the dot plot at 2, or is it going to be different than 2?
It's going to be more than 2.
It's going to be more than 2. I agree with that. I got 3 to 4 again. I had 3 to 4 cuts last year, and I got 3 to 4 cuts this year.
Listen, if this Fed does not move at Trump's speed,
they're gone. All of them.
They're gone. Like and Jay Powell can get up.
I don't think the Fed understands the power that Trump has right now.
This Jay Powell can be there and says, "I will not resign," and he can pound. Jay Powell, you are a coward.
Guess what? The FBI director said that, and a week and a half later, the FBI director resigned.
If Trump and the second, and listen, if you think you're going to restrain a restrictive monetary policy under Trump, you're smoking crack. Like, he won't allow it, and you can argue. That's good. You can argue that's bad. I don't care. The reality is he won't allow it.
We lived through him yelling at Jay Powell in 2018. We know,
and this is whether it was 1.75.
And that was at 1.75%, and they were talking about not cutting.
And they're talking about not cutting.
Yeah.
So, you think, so 3, 4, 5 cuts, like a lot.
Later, they cut.
And here's the thing, right? Are there inflationary pressures that can push your yields and tear? Sure. But at the end of the day, the most important thing is the path of monetary policy. I have that with more cuts, not less.
More cuts than it.
I get the other side of the argument. I get the debt burden pushing yields.
Absolutely.
Guess what? It's the same argument that was.
And agree with it 100%.
It was the same argument that was being had in the summer of 2023. Well, listen, you got a lot of debt, you got to finance it, and there's all these extra, and it's pushing up. And then what did Janet Yellen come in and do? Boom! Drop it. Institutional powers, if they want those down, they get them down. Trump's going to want those yields down. He's going to want to run a hot economy. And I don't think they have any respect for inflation. I think that has ramifications. But I also have the dollar way down and 3 or 4 cuts, and yields, they're not going to keep climbing.
Let me be clear on the inflationary side of it, though. The concern on inflation is not a double dip to 9-10%.
No, that is not. It's the grind.
If there was that concern, we would have a vastly different conversation. The concern is the grind at 3%.
The grind, the constant seeing, and in your real life seeing the 6, 7, right? In your
because when it was reported at 9, you're in your real life it's 17.
Yeah.
Right. So the reported at 2, real life it's 5.5. So it's you're absolutely right. It's that grind. So we're not talking about if inflation was at 9%, Trump would most likely treat the environment vastly different.
You have to, because
you don't have a choice.
You don't have a choice, because
at 2.5 to 3%
you have a lot more wiggle room.
Committed. I don't
especially when you subsidize oil.
I don't find the Fed that committed to a 2% target.
Of course they're not.
And so I don't find that at 2.8 to 3%, the Fed's going to fight the pro-growth policies out of the Trump administration with as much vitriol as they might otherwise do if inflation was at 7, 8, 9%. Does that make sense?
Yeah.
So, I just don't think Trump's going to get a lot of pushback from the central bank, because the very second Jay Powell pushes back is the very second I know Jay Powell no longer works for the Fed.
Either Powell will get on board, or somebody Trumpy will get in there. Like that's how it's going to play out.
That's how it always plays out. This is not abnormal. Either do what I say.
And if you think it plays out any other ways than that, you go find one central bank president in the history of mankind from any country that was able to go against the dictates of those in power.
The United States, Volcker.
Okay, Volcker was that's why we call them Volckers, right?
But that's also when the Fed started owning the government as well.
So, I think Powell's gone.
So we both have cuts. Chucky, I appreciated this conversation. I love the detail that you brought. It was fantastic. I was able just to kind of sit back and just kind of respond. It was fantastic. You want to give us some final thoughts?
Yeah, go buy some Bitcoin on the next technical signal. Respect those technicals, right? And this is the thing. Things change. Were we right on energy at the first 3-4 months? Absolutely.
Copper.
Were we right on copper? Technicals change, right? And the story changes, right? You have this case going into any time period. Now, it's always fun to do it on a year long, right? What's the whole year? But as traders, what we do is we keep bringing in the information. We keep processing the information. And then, for example, I like Bitcoin. Obviously, I like Bitcoin, right? And then we pay attention to the technicals, right? I'm not going to add Bitcoin tomorrow unless you break out of a certain technical signal. And that's what we do as traders. And that's what we try to help people do at tackletrading.com in our pro community. And share that information here on the podcast, right? It's all right, we think this. Now, what's our action signal? Bringing in technicals to whatever, larger thesis. And when none of it's playing out, we smash some covered calls.
That's right. That's right. If you've enjoyed the podcast, the predictions, like we said, we'd like to have a lot of fun with this. But at the end of the day, you got to navigate the market. You can't just predict the market. And everybody at Tackle Trading knows that. If you are looking for an amazing community to be a part of and navigate 2025 every day with, go over there to tackletrading.com. You can sign up for a free pro trial membership. And if you are interested in making 2025 the year of cash flow for you personally, start compounding those gains and start building a legacy for your family and beyond, we'll come over to my December 30th webinar at 8:30 p.m. Eastern Standard Time on Covered Calls. It's the Tackle 25 Master the Income Strategy. We're going to have a lot of fun on Monday. We're going to learn a lot about covered calls. And as always, I hope everybody has a wonderful, wonderful week. And if you need anything from us at Tackle Trading, to hit us up at team@tackletrading.com. You can always hit us up in our Discord channel or any social media we have an account at as well. With that said, everybody have a wonderful rest of your week and hit that like and share button on the way out the door.
Have a great week, everyone.